change in the difference in rates between the U.S. and the U.K., they're 25 basis points lower. So, yes, it's different, but it's whenever we talk about rate differentials and currency pairs, it's also what the actual nominal difference is, what it currently is, and what the trajectory is. Mm-hmm. Right now, the trajectory in the U.S. is
flat, down-ish, flat-ish.
Yeah. Maybe a little bit lower. I think there's a cut built in somewhere at the end of the year, which in my mind is like no one's got a clue.
Yeah.
Here you've got two of the guys saying that we should have done more, which leads you to imply, in the market implying a little bit, there's definitely another one coming out of the woodwork in the next policy.
Well, a lot would
next MPC
a lot
meeting.
would have to change. Their data would have to be like screaming off the page in the other direction.
So they're down today, and the trajectory is down, where ours is relatively flat. The trajectory piece is what drives. Again, the market had completely priced in a 25 basis point cut at this meeting. So it's like, well, if it's priced in, why you keep saying the markets are efficient? Why did we move from what was already priced in? Mm-hmm. It was the statement that, again, some guys were looking for even more. So that now starts to get priced in on the fly. That's why we see pound so much lower.
And you can even see it here. It doesn't tell the full story, but previously 3 of the 9 Bank of England members had voted for a cut. They were expecting 8 of the 9. All 9 voted for the cut. And to your point, it sounds like a few of them were even more dovish on the future path for interest rates in the UK. So really interesting one there. Yeah, man. I mean, don't we live in such a globalized economy, though, that if, the first domino to fall were some of the more risk-on economies. I don't even know if that's the right way to the commodity economies.
Traditionally, that's where you see the stress of pricing and demand show through first.
Sure. Australia, New Zealand, Canada. Australia, New Zealand ties to China.
Right.
So some of the just more, let's say, more volatile economies. Yeah. You see those dominoes fall, and then you see some of the dominoes fall across Europe.
Yeah.
And now the UK. The US, and I'll pull up the FedWatch tool while you enlighten us here, Pete. Are we now in an economy where the US is more siloed off from some of these other economies? Or, I mean, if you think about the last 10 years, every central bank has moved pretty much in the same direction, maybe give or take a few months. But yeah, now you're seeing all of these central banks move. And again, the expectation for the Fed this year is maybe 25, maybe 50 basis points lower throughout the entirety of this year. And it's the beginning of February.
Right. So we talk about, you mentioned the globalization of the economy, but we're seeing very disparate performance metrics.
Yeah.
The Chinese stock market dramatically lower, the German stock market lower, the CAC in France, the FTSE in the UK, and along with their employment numbers all contracting. So, yeah, there is this global, part of what we've seen in the last 2 weeks is that there may be an interest from the U.S. to again, we don't care about you guys. We don't want your products.
To take the global piece out of it even
more.
We
don't want your products coming in unless you build them in the United States to silo it even more. That's kind of a little bit of a different discussion, but yeah, we're definitely seeing a dichotomy in how the market is digesting this, and the UK being very comfortable. Again, their rates are still relatively high to rates in, Aussie rates in the 3s level. Kiwi
even
rates
the Euro
in the 3
area,
level.
right next to them.
Euro, right, in the lower end of the 3 levels. So one of the tools you go to is, again, rates is to stimulate your economy. And one of the good things that come with that is your currency softens up to get a little bit more competitive.
Well, we're definitely seeing that today. Yeah, I mean, let's take a look.
This will be interesting because they did try a little bit of a bounce right after the number. Okay, we got the bad news price, and the tape statement around the two guys wanting 50 was priced in. Now, what's interesting is we either see that kind of that spike lower, that algo-driven headline news, and then it kind of recuperates. And when we're back to 124.20 or unchanged on the event, in my mind, from my years of doing this, that means, okay, that's parsed with, and chances are we trade a little bit higher. Now we had the lower trade, a little bit of a bounce off of that.
Yeah.
Now we're rolling. If we roll into the U.S. session, getting through 123.5, I would think the market's going to be a little bit challenged as to how much more downside there is to do. So it'll be interesting. And again, this is downside not from 121, which we were close to at some point, but this is downside from the upper end of the range.
Well, yeah, you look at this, and it doesn't look like strength, but this is relative strength to almost any other major currency outside of maybe the yen. The yen depends on the week. I don't know what the heck's going on with yen.
No, but and Glenn ran a great series of correlations yesterday. I think he posted it on YouTube or on our somewhere on social. That yen correlation to the other currency pairs is zip.
Yeah.
I mean, it's 0.16, it's 0.06. Yen's just, it's, you know, when you trade, you may have an idea about Aussie yen, and that actually has the highest correlation. And I don't know if that's because there's more trade or whatever. None of them significantly correlated. So do you have a pairs trade offsetting risk? I don't know on that one. That's a harder thing because they seem to be kind of independent, uncorrelated occurrences. We do know euro sterling and
well, so let's take a look at that euro sterling just to see some of this. As you can see, you know, we've been hanging out here around the lows for euro, highs for pound, showing you a little bit of that relative strength. And historically, you see the last several years, again, we've been here at not the lows that we saw back in this 2015, 2016 kind of price extreme, but the lows for the last several years, euro versus pound. And so you start to wonder, okay, well then let's take the US piece out of it, Pete. Let's say they're siloed off and, you know, it's going to be tariffs and kind of all this other stuff, and the interest rate story maybe isn't as interesting. Is there potential for mean reversion here? Let me go to the weekly chart just to maybe show probably a better picture. Yeah, is there potential here for mean reversion in the longer term? Who knows what's going to happen today, obviously.
Right.
The pound's going to be flying all over the place just based on what's going on. But in the long term, is there something here for the euro closing the gap on the pound if interest rates in the UK close the gap on where the ECB has them?
Absolutely. And I think, I hate being armchair quarterback, but when you look at that euro-yen chart, even on the shorter term basis, and you were going into this event risk, that gave you an interesting level in terms of a low within the range if you wanted to be long some euro against sterling.
Yeah.
And that would be one way to actually play, kind of take out just a pure dollar cable exposure and play the relative value of the two at a better. So in other words, buying sterling here, hoping that they are dovish in their statement. You're buying a market that's rallied 350 pips. Here, the euro sterling trade gave you the ability to get a little bit of value in that euro piece at a much lower level.
Yeah,
so
I can see
right there. You look at it. That's a great time zone to look at it. You don't want to bury yourself in so many pairs you get paralyzed as to what to do. Mm-hmm. But if you're again a pot odds trader looking to trade the range, you want to be long at the bottom, short at the top. This is a great way to find that versus trying to buy sterling or even buy euro up here, the euro sterling pair. And to build this anywhere else, ETFs would be such an expensive exercise with FXE and FXB. Futures, you can build it, but it's difficult to do and it's hard to construct. What I love is that I don't have to go build something. The product's here. I can just trade it.
Well, and a nice piece of this that I personally look at with markets like this, or markets like crypto or whatever, where the nature of them is so customizable.
Right.
Let's say, is you can say, okay, I have X dollars or I have Y number of lots that I want to trade
Right.
in forex or crypto or whatever, versus a futures
Right.
or more structured market where it's like, okay, I want to chop up though going into this Bank of England meeting. Okay, I've got an idea of what's going to happen pound dollar, but instead of putting it all on the line there, to your point, Pete, going into this, if you're going to short the pound, let's say, doing it with a long euro versus pound exposure versus a long dollar versus pound exposure is a better value play. Now, value plays aren't always the winner, right. And especially look at the stock market, the growth play, the trending play has been the winner.
We can't all be long Palantir. So,
but this allows you to say, okay, I can, if I wanted to just put on one futures contract, I've have to put on one futures contract, and replicating a non-dollar cross is actually really hard to begin with. But what's really cool about these events in a Bank of England and a pound here is you can chop up that money, that exposure, whatever you want to say, that trade idea, 3, 4, 5. Actually, I think you can do it. Most forex providers have, I think, 15 to 20 pound
right.
cross pound pairs. But that's a really nice piece, Pete, because a lot of times it's a binary bet. I mean, let's say it is Palantir earnings, and it's like, okay, I gotta. Even
right.
if I'm using options, I'm pretty much betting up or down on this Palantir earnings. With this, a lot of nuance to it that, at the end of the day, pound gets smoked. That's the story. But you can layer that in so many different ways. And I totally agree with you. We haven't looked at this euro sterling in so long.
Right.
This would have been a better value play from shorting the pound versus you go to the daily chart over here, and it would have been like, all right, I'm shorting at 124.50, maybe 125 if I got a really good price. And this market can easily run into the 130s right. and get away from me.
Right. And that's what, the fact we offer 82 FX pairs doesn't mean we want you to go down the rabbit hole of all of them. But when you look at, okay, I got a binary event, we know that looking at that euro sterling, just eyeballing it, the vol on that pair is a little less than having euro US or sterling US. So you're mitigating a little bit of the event risk. And from a value level, from a pot odds standpoint, you're getting the lower end of the range. So it gives you the market anywhere from a pip to a pip and a half wide. So it's a liquid market. Gives you a little bit different way we talk about how do you shape exposure around binary events. We always talk about getting smaller, or how can we sometimes optimize the fact that we don't know what these guys are going to do. Mm-hmm. We don't know what the outcome is going to be. How can we find opportunity in it? This is a case where you move one level down from the core all dollar-based pairs into a non-dollar-based pair for a little bit better opportunity.
Well, and it's all risk-reward as well. So, I mean, take a look at it this way for a second. I'm just going to put these right next to each other so it's easy for me. Euro sterling, up 0.6, 0.7%. So essentially, pound is down 0.6, 0.7% against euro. You look over here and you say, well, Frank, I would have gotten more bang for my buck being short this pound versus the dollar. It's down 1%. Okay, this is a 100 pip move. And looking at the same, we're going to look at the same time range for both these markets here. Looking at the last several months, this is a market that has moved more than 1,000 pips. And so this is 100 pips on more than 1,000 pips. This move here is about 50, 60 pips over the same time range here. This is a 300 pip range. Yeah. And so when you're talking about risk versus reward, right. And it's, of course, I have to caveat this, anything can happen at any time. The euro can, for some reason, get annihilated relative to the pound, but the U.S. dollar. It's a euro U.S. dollar story. They're both getting hit for anything can happen. Weird stuff. But when you look at, okay, I want to try to make X amount and only risk Y amount.
That's the key.
Here,
Yep.
you're looking at what have been a smaller gain in your short pound position. But to your point, Pete, the market is only 50 to 100 pips going into this event, 50 to 100 pips away from its low for the last year, so a little bit better value. And this market has only tended to move, a 30, 40, 50 pip day is pretty much the biggest day you can see here in all the data for the last several months. And so you got to weigh these things,
And you're right. Your statement around, I would have made a full percent on the sterling moves. That would have been the place. We don't know what these events are going to take place. So
that's if you were
could
on the right
have
side.
lost a
Yeah.
percent on that full move. I don't like to. You've got to always think about not what you're giving up, but what you're protecting around uncertainty. Again, this is a known unknown. We know it's coming out. We don't know what the market's going to do with it.
Sure.
And I would always look to find a way to get the exposure I want, but how do I do so in the most efficient way, both if I'm right and if I'm wrong?